Good day. My name is Rossouw, and I'm a portfolio manager with Adviceworks Private Client Securities. I'd like to spend the next quarter of an hour talking to you about the global COVID-19 pandemic and the impact that it's having on investment markets. I'd also like to share some thoughts with you on how Adviceworks sees the way forward. The second COVID wave has traumatized the people of India. The number of new cases recorded daily is now approaching 400,000 and the daily death toll nearly 4,000. Hospitals are inundated with critically ill patients and are running out of ventilators, oxygen, and medical equipment. With cremation an institution among Hindus, crematoriums are working overtime, their chimneys cracking and iron frames melting from constant use. Wood is in short supply in many places, and families are being told to bring their own. Because official facilities are swamped, informal cremations are being held in parking lots and parks. As of Thursday night, more than 151 million people have been infected with COVID-19 worldwide, and more than 3.2 million people have succumbed to the disease. The United States remains hardest hit, with over 33 million infections and more than 589,000 deaths. India, Brazil, France, and Russia now make up the rest of the top five, and South Africa is still in 20th position in terms of most recorded cases. On Thursday, nearly 900,000 new COVID-19 cases were recorded worldwide. Of these, nearly half were reported in India alone, but experts warn that this is probably an undercount as India's testing capacity has been overwhelmed by new cases. Most of the hardest hit countries have managed to contain the spread of the virus since my previous report, but what is concerning is evidence of new variants which may not be susceptible to existing vaccines, as well as the resurgence of the virus in countries where it had seemed under control, like Japan, Iran, and Canada. The daily COVID death toll has been rising steadily since the beginning of April, from around 10,000 cases per day to over 15,000 on Thursday. As could be expected, about a quarter of the fatalities this week occurred in India, and that number should also be taken with a pinch of salt, as many victims there die and are cremated at home. The situation in Iran has also cause for concern, as its healthcare system has been hollowed out by decades of sanctions, and the focus of current international aid efforts is on India. Because many of the early vaccinations used the Pfizer and Moderna two-shot vaccines, there is a huge disparity between the number of vaccine doses administered and the number of people who are fully vaccinated. This infographic provides a single view of the two numbers. Unfortunately, China does not disclose how many people are fully vaccinated, merely how many doses have been administered. Since China, like the United States, initially only used two-shot vaccines, it has to be assumed that the ratio between doses and fully vaccinated people in China is similar to that pertaining to the United States. China has now administered more doses than any other country, 236 million. But given its population of 1.4 billion people, this probably means that only about 100 million Chinese, or roughly 7% of the population, are fully vaccinated. In the United States, the numbers are 232 million and 97 million respectively. What is of particular concern is that although India is the largest producer and exporter of vaccines in the world, only 24 million Indians, or 1.7% of the population, are currently fully vaccinated. Oxford Economics projects that the resurgence of COVID will result in India's GDP growing by 2% less this year than the 12.5% forecast by the IMF. Business and consumer confidence are both rising in most major economies, and the US Federal Reserve remains sanguine about inflation risks. President Biden has committed the US to reducing its carbon dioxide emissions by 50% by 2030, and the British economy is expanding fast. The United Nations Food and Agricultural Organization reports that food prices are still rising fast, and foreign spectators will probably not be allowed at the Tokyo Olympics. Meanwhile, the global microchip shortage has spilled over from the automotive sector to personal devices and appliances. The composite flash purchasing managers indices for the United States, Britain, and the Eurozone all trended upwards in April, with the reading for the US, the dark blue line, the most bullish at 62. Britain's reading of 60, the green line, was a close second, while Europe, represented by the light blue line, recorded a more subdued 54. This probably reflects the relative success of the three economic blocs in the struggle against COVID, with the Eurozone underperforming its two counterparts. America's massive trade deficit vis-à-vis China rose to $640 billion in February, when US exports to China, the dark blue line, grew by only 3% year-on-year, and Chinese exports to the United States, the red line, increased by a whopping 13%. Although the Biden administration has been more diplomatic towards the Chinese than the Trump team, this imbalance is bound to be a source of tension between the two superpowers going forward. Even though China is the world's fourth largest producer of soybeans after Brazil, the US, and Argentina, the country's massive demand for soya, both as a foodstuff and an animal feed, means that it imports most of its annual consumption of roughly 100 million tons. China gives preference to imports from its BRICS partner Brazil, but inclement weather delayed the harvest there, which resulted in a windfall for farmers in the US Midwest. The value of soybeans exported to China in March totaled $3.93 billion, the third highest monthly total in history. The main driver of Chinese demand is the feed required to rebuild the country's pig herd, which was decimated by African swine fever some years ago. Global equity markets were fairly quiet this week, although the S&P 500 managed to reach yet another all-time high. About half of the companies in the index have so far reported, and especially in the technology sector, results have been excellent. The market is torn between the hawkish noises from the White House and the dovish pronouncements by the Federal Reserve. Bond yields are rising once more, but the US dollar is weakening. Lower demand from India, the world's third biggest consumer, is restraining the rise of the oil price, but copper and steel prices keep rising. Tesla's foray into the cryptocurrency market has made Elon Musk more than $100 million thus far. Despite the abject misery caused by the second COVID wave in India, Mumbai's Sensex was the best performing major index this week, and Korea's Kospi the worst. Taiwan is still benefiting from the world's insatiable demands for its microchips, but the Nikkei in Tokyo had a poor month. Taiwan's main index has now left the JSE Top 40 in its wake for the year to date, with China's A50 bringing up the rear. Over the past 12 months, the Russell 2000 and Hang Seng are top and bottom respectively, and over 3 years, the Nasdaq and the FTSE 100. On commodity markets, nickel stood out this week, along with lesser-known rhodium. Oil, iron ore, and copper had good weeks too, as optimism over economic expansion seemed to trump fears over COVID. For the past month, iron ore and cobalt were the best and worst performing industrial commodities, and for the year to date, lithium and gold. For many years, gold has been regarded as a hedge against inflation and uncertainty. The current environment would seem to provide ideal conditions for a gold bull market. Fears over inflation, combined with generally loose monetary policy, fiscal stimulus, a weak US dollar, and geopolitical turmoil. Notwithstanding this, the gold price has been languishing in recent months, partly because alternative hedges like cryptocurrencies have caught the eyes of investors. Still, do not be surprised if higher than expected inflation leads to a rise in the gold price later this year. The IMF believes that global GDP growth this year will be the strongest in decades, with next year less so but still robust. The pandemic seems to have left few long-term scars on the global economy, and it is too soon to tell whether the current recovery is sustainable over the long term or merely a reaction to massive stimulus. Although inflationary pressures are building everywhere, these should recede as supply chains normalize. Average developed market inflation over the next few years will, however, be a bit higher than in previous decades, but runaway inflation is unlikely. Given the extent of inflationary pressures, central banks will probably have to start hiking interest rates sooner than they're currently saying, but later than what the market is pricing in. Even if inflation is persistent, there is a limit to how high bond yields will rise in a world with excess savings looking for a low-risk home. We must, however, point out that the post-pandemic re-rating of equity markets is behind us and that future returns will have to be the result of earnings growth. The environment remains positive for risk assets, but we believe that different markets will come to the fore and that different sectors might outperform going forward. We remain positive about global equities, but we expect a continued rotation out of technology to more cyclical sectors. We also expect emerging markets to outperform developed markets, the East, the West, and Europe, the United States. The biggest risk to the equity market is rising bond yields. We remain skeptical about fixed income where yields are still negligible. We worry about the inflation fears that could trigger a fully fledged sell-off. We remain neutral about property, which, whilst cheaper than pure equities and yielding better than bonds, are. This week, President Ramaphosa appeared before the Zondo Commission of Inquiry into State Capture in his capacity as President of the ANC. Although he was evasive about why the ANC didn't do more to fight corruption and prevent state capture, to his credit, the President did admit that state capture was a reality and that leaders and members of the ANC had been among its perpetrators. He distanced the party from the actions of members involved in state capture and undertook to initiate disciplinary procedures against those found guilty of misconduct. He refused, however, to concede that his party was inherently corrupt. On Thursday, a further 46 people died of COVID-19 in South Africa, which brings the total death toll to date to 54,331. Nearly 1.6 million South Africans have now tested positive for the coronavirus, and almost 308,000 people have been vaccinated after government resumed its vaccination program this week. Gauteng has the most reported infections with 423,000, and the Western and Eastern Cape have both suffered around 11,600 deaths. KwaZulu-Natal, the Northern Cape, and Free State currently have the most active cases. This week, the leading epidemiologist, Professor Salim Abdul Karim, warned that the country should brace itself for a third COVID wave this winter. A public sector strike over government's pay freeze looks more inevitable by the day, and AfriForum and Solidariteit have successfully challenged the Tourism Equity Fund, which they maintain discriminates against minorities. South Africa's standards of governance is ranked 4th in Africa, and the United Kingdom has banned the Gupta brothers and their money from its shores. A bumper rooibos tea crop has sadly led to a collapse of its price, and Mango can operate again after settling some of its debt to the airports company. And finally, the Minister of Sport has lifted his suspension of Cricket South Africa. One of the South African Treasury's biggest headaches is the size of the public sector wage bill. South Africa currently spends nearly 15% of its GDP on the salaries and benefits of public servants, nearly 50% more than the OECD average of 10.2%. Only affluent Denmark and Norway, with their strong tax bases, spend proportionally more, and economic powerhouses like the United States and Germany both spend less than 10% of GDP on their public sectors. Unemployment has long been one of South Africa's biggest challenges. A recent survey has once again confirmed that we have the world's worst unemployment rate at nearly 33% of the population. But even more worrying is that youth unemployment stands at nearly two-thirds of young South Africans. Interestingly, unemployment is by no means only a third world problem. Mediterranean countries like Spain, Greece, and Turkey have general unemployment rates well into double figures, and Europe in general has a major problem with youth unemployment. Not only do Spain, Greece, and Italy have rates in excess of 30%, but even rich North European countries like Sweden at 24% and France at 19% have millions of idle and frustrated young people. Hopefully, the record high fuel prices of recent times will not become a permanent fixture. The price of Brent crude oil in rand terms, the dark blue line, is far above its long-term averages, and the recent sharp rebound in global oil prices seems to have largely run its course. With the rand firm on foreign exchange markets, there is a good chance that petrol and diesel could become cheaper in the months ahead. If so, it would have a beneficial effect on consumer price inflation. South Africans should brace themselves for a new round of load shedding during the coming winter months. Although Eskom has just completed a program of power station upgrades and maintenance, the demand for electricity, the pink dotted line, has risen in recent months and is now back to the levels experienced during the autumns of 2018, the pink solid line, and 2019, the purple line. Many of Eskom's generators still suffer from frequent unscheduled outages. Although independent power producers have been contracted to provide additional electricity, they will only start feeding power into the national grid from August 2022 onwards. The JSE ended the week fractionally higher, with only the financial sector rising significantly. Bond yields rose slightly, and the rand remained firm against the US dollar. South African Airways has announced that it plans to lay off half of the staff at its technical division, and Vodacom and MTN are competing for operating licenses in Ethiopia. Pepkor is expecting strong half-year results, and its European sister company is about to list on the Polish stock exchange. The JSE attracted a modest inflow of foreign capital to the tune of 70 million rand last week, while the bond exchange suffered an outflow of nearly 5.7 billion rand. For the year to date, both markets have suffered outflows, the JSE just over 8 billion rand and the bond exchange over 35 billion rand. One of the key determinants of South Africa's economic well-being over the course of this year is the exchange rate of the rand. Because the value of our currency influences both the cost of key imports and the competitiveness of key exports, its importance cannot be overstated. A recent study by ABSA found that most market watchers, represented by the pink line, expected the rand to remain more or less range-bound at around 15 rand per dollar for the next 12 months. Some projections were as strong as 14 rand per dollar and as high as 17 rand 50 to the dollar. ABSA itself, however, represented by the red line, foresees the local currency gradually weakening as the expected economic recovery leads to a higher propensity to import, and the rand ending up at 15 rand 50 per dollar by the end of the first quarter of 2022. South Africans are justifiably proud of the quality of locally produced wines. Our wines are also extremely good value for money thanks to our relatively cheap labor. Despite these advantages, South Africa earns substantially less from wine exports than our other New World wine producers like the United States, Chile, Australia, or New Zealand. France is by far the world's biggest wine exporter, followed by Italy, Spain, Australia, and Chile. Since quality and value for money are on our side, the marketing of our wines needs to improve as a matter of urgency. Locally, the equity market has been strong so far this year, but valuations are still fair and prospects for earnings growth look promising. Real bond yields remain attractive, but we remain mindful of risks to the fiscal outlook going forward. We continue to avoid listed property and regard cash merely as a liquidity tool because of the low interest rate it offers. The Adviceworks asset allocation view can be summarized as follows. We remain overweight global equities because of the greater opportunity set they offer and our long-term concerns over the structural vulnerability of the rand. We are gradually adding to our local equity allocation and remain neutral on global property. We still avoid local property because of the uncertainty over the long-term health of the sector and hold no global bonds unless specifically mandated to do so. We are also maintaining our tactical overweight position in local bonds. Thank you very much for your time and attention. We certainly live in interesting times, and I hope that this presentation will help you make sense of them. Should you have any questions or queries, please don't hesitate to contact me or your Adviceworks financial advisor. I hope you'll have a lovely day and a splendid weekend. Until next week, goodbye from me.